And thanks for joining us on our Minorum Gold YouTube channel. Again, on part of our interview series, I have a very special guest with us to talk about the worldwide economy, hence the topic earthquake economics. Today we have Mr. Peter Krauth, a former portfolio advisor and 20-year veteran of the resource market. His specialty is in energy, metals, and mining stocks. Peter, thanks for being on the segment today.
Thank you, Sunny. It's my pleasure.
Excellent. For those people who don't know you and what you do, can you just give a brief background on your newsletter and what you do nowadays?
Sure, thanks. Yes, I am a regular contributor to Money Morning. I cover a lot of sort of macro topics, economics. My background is in the resource market with a particular emphasis and specialty in the precious metals area.
Excellent. So, you've read some, you wrote some pretty interesting articles over the last, a couple of years actually, but I was just looking at some of the more recent ones that cover really on the worldwide debt that's been just accumulating quarter after quarter, month after month, day after day. And, where are we in terms of the worldwide debt numbers, and you can go into specifics of countries even.
Absolutely. Sunny, it's really very interesting. I can say for myself, it's something that I obviously follow very closely, and it just sort of never stops amazing me. In the last just 7 years, for example, the total world debt has actually gone from 142 trillion to 200 trillion, which is a 40% increase. That's 60 trillion extra dollars of debt in just 7 years. It's just amazing to me to think that the world was able to add 40% to its already massive debt levels in just as little as 7 years. So, I ask myself, did central bankers forget that massive debt got us to the problem that we were at and, for sure still are at back in 2007, 2008? Or is it because that's really all they know to do? And I think the answer is the latter, for sure.
Mm-hmm. So in terms of, I don't know if you have this on hand, but in terms of specific countries, are there any countries that have the most debt or have an accelerating rate of QE, and where does interest rates play in general terms of the worldwide debt numbers?
Sure. Well, let's start with Japan, which is certainly the poster child for debt, because their country has 240% debt versus GDP, which is just absolutely astounding. It's much higher than anybody else, and really for the time being it's only sustainable because so much of that debt is actually held by Japanese citizens.
Right.
So it's considered I guess somewhat more stable for your own citizens to hold your debt. You're not at the mercy, for example, of other countries that sort of threaten you with doing different things, selling it, calling it, that sort of thing. So, but just that raw number, the 240% of GDP, that to me signals that Japan is one to certainly watch very closely. I think it could easily be the first domino to fall. We're a lot of eyes are obviously on Greece right now. We can talk about that in a minute or two, but just that those numbers for Japan are so high, it's definitely one to keep a close eye on. After Japan, the other sort of big economies and areas to watch, the U.S. is at 102%. Now that sounds a lot better than Japan, but it's still very high, 102% of GDP. But for them, with having the world's reserve currency and the ability and the willingness to print at will, it's certainly less onerous for them. But still, if you look at their pure debt, outright debt, we're looking at, and this is without including certain future promises, just at the current level, we're looking at $18 trillion, which is really the most ever in history for a single country. And that's, it's not difficult to imagine that that's not likely to end too well. If we look at the Eurozone, for example, they are a little bit better, 92% debt versus GDP. But here you've got some regions that are certainly a lot worse than others. And interestingly, if you look at China
Yes.
is actually
Well, I was
way
just
down
about to mention
at
that, yeah.
22.4% of GDP, debt versus GDP.
Mm-hmm.
And on the other hand, $3.7 trillion in reserves. So this is, a serious cushion that they have that they can use to help themselves, in times of financial trouble.
Mm-hmm.
So, to answer sort of the second part of your question, you talked about how interest rates play in all of this. Well, I think that, anyone, again, who's been sort of observing, watching, and figuring out, how does this work and what the implications are, I would certainly say that if you think about how much debt countries have, certainly it explains why interest rates are so low. Because,
Right.
For rates, I think I read at one point that if rates went up just a few percent, for example, for Japan, which has had the worst case, if interest rates went up to something like 5%, they would actually be spending all of their government intake on taxes just to pay interest.
Right,
There'd
exactly.
be nothing left to spend on anything else whatsoever.
Absolutely.
So
Yeah.
that's a pretty terrible situation. And I think it's why we can probably pretty much expect rates to stay low for a very long time, and it's why in some places and some instances we've gotten to the point where we have negative interest rates, which means that some bond buyers actually pay to buy bonds and receive less when the bond matures than they actually invested, and they're doing it for issues of security. They feel that it's still, despite the fact that it's getting less than their original amount back,
Mm-hmm.
it's a safe place to put their money. Others are doing it because they're basically playing for the greater fool type of scenario where they think someone will buy it from them at a higher price still, and they think they can turn around and make, albeit small, make some sort of profit on it. So, at some point, rather than pay to park their money at the bank, I think people and businesses are going to realize that they prefer to rather just withdraw their cash and sit on it. And that, when we get to that point, I think that will be, a bit of a milestone for the banking system, because people will be looking for ways to just not leave cash on hand at the bank. And the IMF has actually warned regulators to prepare for, at some point, some sort of a global liquidity shock.
Right.
It's something that, if the IMF is warning for something like this, and we know how, they work closely with central banks,
Yep.
Their information certainly is pointing to these kinds of risks, I think, quite clearly.
So how does Greece play into this? They're on the verge of bankruptcy. Will they leave the EU, you think, or how does that work?
Well, I think that I think that it's likely. I think it's probably more a question of when rather than if. I think that we're likely, even as we speak today, tomorrow, there are really high-level talks going on between Greece and its debtors, and as creditors, sorry. And I think that there's going to be some sort of a 11th hour compromise,
right,
kicking the can a little bit further down the road. But I mean, it's not surprising to see that Greece has gotten to this point for different reasons. The rhetoric has certainly changed since the Greek elections back in January. The Greeks voted in a new government that is anti-austerity, and that we see in sentiment in Greece, and that's why Syriza, the current party, was elected.
Right.
People are just fed up with austerity. They're fed up with being told by the EU how to do things. And yet, Greece's economy is just 1.4% of the entire EU. So,
right,
this is the most indebted nation in all of the EU. They owe $323 billion. I don't see any way that they're ever going to repay this.
Right.
So they owe more money than any other nation inside the EU, and yet economically they're tiny. They're 1.4% of the EU. So, I mean, what they owe versus what they can generate is there's just a massive gap there. A couple of interesting points, for example, to note are in these bailout deals, the money that Greece is compete with bailouts, only 8% of bailout money actually ever makes it to Greece. The rest goes directly to creditors of Greece, which is mainly German, French, and American banks, which, as we know, their governments won't allow to fail because it'd be chaos.
Well, it's interesting you say that because in one of your articles you referenced Mr. Paulo Batista, the executive director of IMF, and the purpose of this bailout was that first and foremost they gave money to save the German and French banks, not really Greece.
Absolutely, exactly, and it's interesting because Greece is so feels so painted into a corner at this point that they're looking at ways to counter and argue against the debt that they have, to look for ways to restructure, to perhaps make a new deal, allow creditors to take some sort of a haircut. And some of the arguments are, for example, they're saying, okay, with Germany being the largest creditor, they're saying, well, if you go back to World War II, because Greece was a victim, with Germany in substantial ways, we add up that you owe us over $300 billion of war reparations. So that in itself would apparently just wipe out Greece's debt, that alone. And then they're saying things like, well, it was the previous government that contracted all of these debts, this bailout. We weren't responsible for it. The Greek people had no say in that. So ultimately, we really don't owe this money, or we don't owe all of it. So you can see that they're certainly, looking for arguments to find ways out of, or at the very least minimize the debt that they owe. But I mean, they're grasping at straws. I think in the end, odds are good that they're going to end up on some level. They're going to end up, leaving the EU.
So sorry, go ahead.
Yeah, no, I was going to say they've gotten so desperate that, in fact, in the last week or so, the Greek government actually decreed to all its local governments that they had to send all of their cash balances to the central bank. They were told that it was actually to meet government salaries, but there's about $1 billion bill that's due to the IMF in May, and many observers think that that's the actual reason that they're telling local governments to send their cash to the central bank. They're going to pay that, perhaps both, perhaps government salaries and they pay off their tranche of debt owed by May. But it's certainly not encouraging. And I mean, you even have to ask yourself, in terms of moral obligation of these different sort of local governments. If you think about it, we're talking about municipalities and so on. People pay municipal taxes to their municipal government. Why should that go to the central bank to pay federal salaries? I mean, they're mixing the two, and it's gotten to the point where it's no longer making any sense, and you can see that quite clearly. I think that they're scrambling. Absolutely. And if Greece leaves the EU, odds are the only way to manage that, I think economically, in a practical sense, is they would end up going back to their own currency, which of course would have a much lower value than the euro. And essentially, I like to call it a big reset, which is, what it would be and what it would take. And that, of course, means major losses. But in the end, these lenders should have never made such loans to, a bad debtor that clearly couldn't pay it back then, can pay it back less today. The piper will have to be paid.